Quarter four, right now, it's purely lack of visibility. For Infosys in particular, last 2 years, quarter four has not been good. We have had degrowth. So from that perspective, given the lack of visibility and given lack of, our inability to predict correctly, we have taken a view that second half will be relatively soft. But at the same time, we believe that we are confident that quarter four this year will be different from the last 2 years. It will be definitely, we will see some momentum coming back. So I just want to reiterate that, and we are still reiterating the fact that next year we had said that we'll get back to industry growth rates, and that also we are confident. So the momentum that we saw in first half will definitely is giving us the confidence. But as when compared with the blockbuster H1, H2 is relatively on the weaker side.
Just to add on to what Pravin said, first of all, apart from Pravin and me, two more colleagues are here. Jayesh, who's the Deputy CFO, and Sandeep, who is our Financial Controller, are also part of this session today. Let me slightly step back on a broader piece of strategy execution. If you look at the strategy execution, we're in the execution mode. The 3 or 4 pieces that we particularly focused for the year when we gave the 10 to 12% guidance in the beginning of the year was that how do we look at the large deal, building the large deal pipeline, and also kind of winning the large deals. So if you look at last 8 quarters, historically, on an average, we have won about 500 to 550 million TCV per quarter. If you look at the first 2 quarters of this year, it's about 830 million average. So the trajectory of win is on the upside. That was one key thing. Because we realized that one of the reasons for, in earlier years, our underperformance was on the deal wins. Because the large deals, when I say large deals, it is more than $50 million. They're important as feeder for growth. They are kind of annuity revenue quarter after quarter. They also bring in stability to absorb any quarterly shocks. So they're extremely important. So the trajectory of that is in the right direction. The second piece is really on the top account growth. If you look at Q4 of last year, some of our top 10 accounts degrew. If you look at the first 2 quarters, the top 10 accounts have shown a healthy growth, 5% and so on. So there is the right trajectory there. Now, likewise, we have identified several operating efficiency levers. Of course, we'll need some time, but I think there are some easier ones. There are some harder ones. The easier ones being the utilization, right? Utilization is at 80 to 81%, and we believe that gradually that needs to move to 85%. If some of our competition operates at 85, why not? We need to look at that. And so the strategy execution, if you look at what's the key parameters of large deal wins, TCV, at the top account growth, it's in the right direction. Now, coming back to Q3, as Pravin mentioned, Q3, apart from the seasonality, there are also some specific pieces that we need to address. And we also realize very clearly that Q4 is critical. Q4, the exit rate of the Q4 quarter sets the trend for the following year's growth. Every 1% higher growth in Q4 impacts the entire following year's growth by 1%. We are aware of that, and we are working towards it.
That's quite helpful, thanks. And the other sort of near-term thing that I guess many investors are concerned about is, for example, last quarter you commented about pricing has been quite aggressive, and you've been consistent about highlighting that for the last few quarters. But we've also seen some of your peers comment about aggressive pricing by perhaps Indian firms. Maybe if you can address what is the nature of pricing you've seen over the course of this year and also this quarter. Is it worsened compared to before? And does Infosys in particular need a significant amount of automation as a lever to deal with that pricing, to maintain margins or increase margins?
See, when you look at the industry, there is a lot of transformations happening driven by technology. At the same time, IT budgets are not increasing. So there is IT of our client companies are under tremendous pressure to do more with less so that some of the savings they can flow back to investing in newer areas. So consequently, the run the business or the operation side of the business, there is tremendous pressure on pricing. So many of those deals are coming up for rebid, and there's a clear expectation from clients that they get some 20-30% kind of cost saving upfront over the deal duration. So that is a clear expectation. And they are also very clearly saying in that space, they are primarily dealing with tier 1 vendors who broadly have similar capabilities. So pricing becomes a critical determinant. So in the past, I mean, this is something which we have seen probably in the last few years, and that intensity has continued. For the first year or two, probably Infosys actually resisted getting aggressive into this. But we have seen that now that is a new norm. Instead of resisting, and I mean, that in some sense reflected on our growth as well in the last couple of years. So we said this year we took a decision that it's important for us to price to win, and then later on figure out how to meet our margin aspirations. So that is the approach we have taken, and if at all anything, we have caught up on the competition rather than the other way around. It's not that we are the ones who are creating the pricing aggressiveness. Competition have always been aggressive, and we have started joining the race and so on. Now, what it means is most of these deals are 3 to 5 years duration. So that gives us enough opportunity for us to make sure, even though we price aggressively and with a low margin, but over a deal term, we will have enough margin improvement levers. And some of the levers are typical, some of the traditional levers like offshoring, on-site offshore ratio, the role mix, and so on. Those are anyway available. In addition to that, automation is something which IT industry by itself has not really leveraged in a big way. Particularly when you compare the level of automation that you see in some of the other industries. I use the example of automobile industry where typically about 80%, if you go to an automobile floor, 80% of the work is automated. You hardly see too many people around. Whereas the IT industry, despite being a technology industry, the level of automation that has evolved over the years has been very minimal. So there's a tremendous opportunity and potential for IT industry to do that. At the same time, it is not that you will see the results in today, tomorrow, or anything. Some of it will take over a period of time because the basic level of automation, everyone has been doing it for a year. Now we are talking about the next level of automation, bringing in cognitive intelligence and so on. So that takes over 2 to 4 years. So that assumption is also baked in. So there are multiple assumptions you bake in.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.